Thank you for joining me. Let's jump right into our first IFRIC 1 example. So we have a plant, cost price was R1,000,000, 1st of Jan 2015. Then they tell us we have an obligation to decommission in 5 years at a future cost of 50,000. So we know this will be my future value over 5 years, 5N. My interest rate is 10, and I know that I will have to capitalize the present value to this 1 million as well. Depreciation is over 5 years. 1 year later, on the 1st of Jan 2016, the future cost of obligation to decommission in 5 years increases to 70,000. So that just means that at the end of 2019, I'm not going to pay 50,000 anymore. I now estimate that I'll pay 70,000. And 1st of Jan 2017, this changed then to 30,000. And they ask us the journal entries for the 3 years. So if we look at the first year, I will, beginning of the year, debit plant with my million plus my present value of the obligation. So that will be 50,000 future value. 10 is I, no payment. N is 5, and comp present value. I will credit my bank with a million and credit the provision with a present value amount. At the end of 2015, I would have had my depreciation over 5 years, and I will have my finance cost that will be amort 1.1 interest. Now, 1st of 1st 2016, my future value changed from 50 to 70. My 10 is still the same. My N is now 4 because I will still pay the 70,000 N of 2019, but I now want the amount on the 1st of the 1st 2016. So that will be only after 4 years. So my present value is now 47,000. My old present value calc to get the balance of the provision based on the old estimates. That will be amort 1.1 balance. So the balance for the first period, 34,000, and the difference will be 13,000, an increase. I have to increase this old balance to get to this new present value amount. So my IFRIC 1 journal entry will be where I debit plant, credit my provision, increase my provision. My depreciation going forward after this IFRIC 1 journal entry will be my actual carrying amount on that day divided by remaining useful life. So cost minus depreciation plus then my IFRIC 1 amount divided by 4. My finance cost will now be calculated based on the new inputs, and because the present value of the new inputs was actually the 1st of the 1st 2016, at the end of 2016, that will be period 1.1 interest based on the new inputs. Again, at the beginning of 2017, my future value changed. Now it is 30,000. I still have to pay this end of 2019. 10 is still the same, but the period is now 3 years, as I only want to compute a present value to beginning of 2017. So present value is then 22,000. My old present value calc, so amort 1.1 balance, based on my previous inputs, where my future value was actually 70,000. My balance in my books will be 52,000. So can you see my provision actually should decrease with 30,000. So my IFRIC 1 journal entry will be decrease provision 30,000, credit my plant 30,000. So if I now at the end of 2017 want to do my depreciation journal entry, again it will be my carrying amount beginning of the year divided by remaining useful life. So carrying amount cost minus where depreciation plus my IFRIC 1 minus depreciation for year 2 minus my IFRIC 1 journal entry for year the year 2017 divided by 3, and that will give me then my depreciation. Again, my finance cost will be based on the new inputs, and because my new inputs, the present value was beginning of 2017, then to get the interest for the year 2017, I will use my amort 1.1. Important here, my tax base for this provision will be 0, as deductions will only be given in the future when it actually takes place. So if I use my tax base of a liability, carrying amount less my future tax deductions, it will, for example, be 100 less. In future, you will get the 100 as a deduction, so 100 less 100 will actually then be 0. IFRIC 1, very important that you work through the theory, work through your standard, and please let me know if you have any questions. Thank you.